Hello, Mr. Buffett. I got two short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is.
And there you have it. In less than 30 seconds, Warren Buffett answered one of the most basic philosophical questions you can ask about investing. In this video, I'm going to expand on the answer to that question: how can you know the intrinsic value of a company? What does Warren Buffett mean when he says all the future cash that a company will generate? And what does he mean by discounted at the appropriate discount rate? And what should we do since we aren't all knowing about the future as he suggests is necessary? At the end of this video, my hope is that you will have a clearer focus on estimating the intrinsic value of any company through a simple process so that you can distinguish the intrinsic value from market price. This should unlock a major tool in your investing journey and give you a new paradigm so that you can sleep better at night when you're owning stocks, and you can do it with confidence. Now, first, I want to make it clear that when you buy stocks, you are choosing to buy an ownership in companies, a partial ownership. Even though you can sell your ownership piece at any time in the open market, you should have the mindset when you're buying stocks that you aren't just buying a moving line chart. You aren't just buying an imaginary ticker or a news headline. You are entering a part ownership stake in a real, tangible company. That's why intrinsic value is so important. When you become an owner of something, you should care less about the daily or weekly price changes of that business, as the market, it varies every day constantly. You should focus on something that doesn't change as a result of people's opinion, as the general consensus opinion. What doesn't change is its underlying fundamental value. We should always think of the terms price and value as fundamentally different things. In a market, prices are what people are paying right now in the moment for a company's shares today. Market price can swing up, it can swing down for all sorts of reasons without the intrinsic value of a company changing at all. Fear, greed, sentiment, headlines, opinions, etc. However, intrinsic value is the unopinionated truth. Every company has an intrinsic, fundamental, underlying value that wouldn't change even if the market price went to zero. That's because it's based on what Warren Buffett talked about, the cash that that company will generate to the shareholders of the business. Let's use a house, for example. Let's just say for a minute that you have an uncle who is getting older and he doesn't want to take care of his house anymore. He wants to use some of his life savings and just live in a rental apartment from now on, or live with another family member. He has plenty of other money, and so he just wants to give you his house. It's in a normal neighborhood. He knows that you could really benefit from having the house, and you could manage it and take care of it. So he gives you the house for free. In this scenario, the price you pay for the house is $0. But that doesn't make the house worthless. The house holds an intrinsic value based on the benefit that it can provide to you, the owner. Now, let's say you rented the house to a tenant. You would be receiving tens of thousands of dollars each year in rental income, and thus you could justify selling that house to another person for hundreds of thousands of dollars. I don't know if that would be in good memory of your uncle, or it would be very appreciative of your uncle giving it to you, but you could sell it. You could turn around and sell it to somebody else based on the rental income that it would give you, even if you received it for free. You see, no matter how you acquire the house or what price you pay, the value of the house remains fixed based on the benefit that it provides you by living there or from the rental income you could attain from it. If the market wants to pay you $1 million or $10,000 or $400,000, the value is intrinsic. The value is fixed. It's inherent to that house. The same principle applies to stocks, to companies that we buy in the market. Prices are constantly changing, but value is much more consistent, and there is an intrinsic value at all times based on the true fundamentals of the business. So as an investor, our chief aim should be to calculate the intrinsic value of companies and to buy shares in companies when the price per share is significantly below the intrinsic value per share. In doing that, we will have confidence that we don't even need to wait for the stock price to go up. We don't need to resell this stock ever if the market is wrong forever, because we will make returns simply by that company returning that cash flow, its profits, to us, the shareholders. That way we can wait for the market to realize the true value of the stock, and we can make gains that way, of course, or we could just wait to be rewarded with the return through being paid by that company. Either way, we win. So let's look at an example business to put this process together of how to find the intrinsic value. Consider a vending machine business. This business is very simple. It consists of a few dozen vending machines with certain costs and revenues and resulting profits. Now let's suppose this series of vending machines was a publicly traded company and you could own part of it through shares on the stock market. The question is, what price should you pay for this company? The costs of the company occur on many different levels. There might be recurring fixed costs, like the space that the vending machines take up that we need to pay to various business owners, or the electric power that they consume to operate. Then there is the cost of the goods sold, like the unit costs of the sodas, the waters, the snacks. You also have to pay any employees who spend time restocking the machine, collecting the money, the people who do accounting on the company, or people repairing and cleaning the machines. Those are all costs, and you have, of course, all the revenues, all the money that people are paying for various snacks, and you take that money out of the vending machines every week, let's say. Now, if we took all the money that comes into the machines and subtract all of those operating costs, we have the net income of the business. This is a little bit of accounting background. However, net income is like an accounting term, but in larger businesses, there are certain adjustments, little nuances such as change in working capital and non-cash expenses like depreciation that are factored in. And this would leave us with what is called cash flow from operations. Now, you might be thinking, okay, that's the cash flow that Warren Buffett said to look at all the future cash flow generated by the business, and we should try to project this number, cash from operations. But you would be missing a critical step. To get from operating cash flow to free cash flow, which is the piece that we really look at as value investors, is free cash flow. We have to subtract the capital expenditures, which are other non-recurring, non-operating costs of the business. In our example, it would be the cost at the end of the year to dispose of an old vending machine that just isn't working well and buying a whole new vending machine to replace it. That's not really an operating cost, but that's a capital expenditure. That could cost $3,000 per replacement from our cash from operations. And let's say we had cash from operations of $50,000 that year. If we had to replace 4 vending machines at $3,000 per vending machine each year, that would add up. So all businesses have these capital expenses to maintain their business, and they have to upgrade their equipment to keep the business running. That's why we look mainly at free cash flow, which is operating cash flow minus capital expenditures or property, plant, and equipment expenses, which can all be found on the company's cash flow statement in their quarterly and annual reports. In this example I just gave, the annual free cash flow for the company would be $38,000. This is the money that is left over to shareholders at the end of the day. This money can be paid back in the form of dividends, but it could also be reinvested to grow the company. It could be used to buy other businesses, merger and acquisitions to make the business bigger. It could be used to buy back shares of the company on the open market to increase the percent ownership of remaining shareholders, or it could be used to pay down debt, which really brings up the second component of intrinsic valuation. Assuming that we have perfect knowledge of all the future free cash flow that the company will generate, we have to add in the current assets of the business and subtract all the liabilities of the company, since these are part of what we own as shareholders. This can be found on every company's balance sheet. Does this company have cash in the bank? Does it own land and machinery? Does it own mining rights or patents? Does it have debt or obligations? These are all part of what we are responsible for as shareholders. In our vending machine business, we can count the value of all of our vending machines along with any drink or snack inventory that are laying around, possibly even the value of the machine placements in high traffic locations, all toward the value of the business. Because if we were to sell the business, we could liquidate all of those assets. On the flip side, let's say when the business was getting started and growing, the business took some loans to buy vending machines. Now, let's say the current debt of the company is $120,000. The interest on that debt is included in the recurring expenses, but the actual debt principal is something we also need to subtract from the intrinsic value of the business in our calculation. So let me propose the following formula for all the math nerds out there to summarize what we know about the intrinsic value of a company. Intrinsic value is equal to the present value of all future free cash flow plus today's assets minus the liabilities of the company as it stands today. We are finally moving in the right direction. We know that if we account for these three things, we can rest assured as an investor that we can estimate the true fundamental value of any business. Now let's focus on this aspect of estimating the present value of all future free cash flow. Part of this step is pure mathematics, but mostly it comes down to the real art of investing, the part where we have to guess or estimate based on our knowledge, based on some assumptions, what the future free cash flow will look like. Not even the smartest people, not even Warren Buffett himself, can perfectly predict any company's future cash generation. And that is why we will use a margin of safety in the end to give a buffer between our best guesses and any mistakes or overestimates we made in our projection. Our job is just to do our best without knowing perfectly to estimate what the future holds for any given company. If we can't accurately project a company's future free cash flow, then we are hopeless when it comes to knowing its intrinsic value. But if we know the business or the economy or something well enough to know, okay, I think this might be it. I know I'm not perfect, but I have a good idea. Then we can start to make guesses about that future free cash flow. Let's go back to our vending machine example. Let's say that we are handed the financial numbers, the financial statements of the business for the past 5 years. Let's say the free cash flow looked like this. In year 1, we had $45,000, year 2, $50,000, year 3, $56,000, year 4, $65,000, and year 5, $71,000. Now, there could be tons of ways for us to accurately project the future free cash flow of this business, but the most basic and the most typical way, and often the most accurate way, is just to look at the recent past trend and simply assume a similar pattern in the near term. We can take all other considerations into account always. Like if we foresee a major decline in the vending machine traffic or a boom near a bulk of our locations in the short term, or a decline in free cash flow from some significant near-term cost increases, on and on. We can use all of that for our estimate of the future free cash flow. But just to create a baseline, let's look at the past growth of the company over the past 5 years, which has been very steady, and assume that growth continues in the short term. Let's assume that next year the free cash flow will be 12% increased from the latest year, and that the free cash flow the year after that will be 12% higher, and so on. We would get a free cash flow projection over the next 5 years that looks like this. And you can see that next year it will earn $79,600, the year after $89,000, and then in year 5 will be at over $125,000 in free cash flow. Now we can make another assumption that after the next 5 years, growth will slow as the business reaches a bigger footprint. We could make a different assumption though. Maybe the company will grow even faster at that point, or maybe it will have actually been declining by then. We could use a negative growth rate. Maybe the company will be totally out of business. We get to make our own assumptions when we do this exercise. But let's just say that this business is going to grow by 5% per year over the next 10 years. Then the free cash flow will look like this, with those first 5 years being what we showed earlier. And then over the following 10 years, you can see the cash flow increase until we get to year 15, where the free cash flow is over $200,000. Finally, we should make an assumption about the long-term future of the business. Is this business going to be around after 15 years? If we think it will even exist at this point, let's assume that it will be growing very slowly, maybe 2%. We could apply, again, a negative growth rate to the terminal growth of the company. But let's just say this business will be sustainable. It will be around 20, 30, 40 years from now. So let's just assume a very slow growth rate, 2% per year in perpetuity. This means that the company will keep up with inflation, but it won't deliver incredible growth. In that case, we could project this company into the infinite future. Now, you might say, wait, every company eventually dies, so you can't say it's going to be earning money 1,000 years from now and then discount that to today and then use that as part of your intrinsic value calculation. And that's where the last component of this exercise renders that discussion virtually meaningless. Let me explain. Of course, we want to certainly reflect the projection of the future as accurately as possible, period. But the last function in determining today's intrinsic value will render long-term earnings of the company less and less meaningful. Let's see why. We are looking for today's value of all the future free cash flow. And to do this, we must take into account the time value of money. Why is this step so important? Because all present money deployed has an opportunity cost. That is, when you spend your money on anything, you forego investing that money in the next best investment for some expected return. When we talk about a company earning $100 of free cash flow next year, you should not spend $100 today on that cash flow a year from now. You should be spending something less than $100, equivalent to the discount rate of using a rate of return we could achieve in the next surest investment. In other words, if I have $90 today and I can grow it at 11%, then I'll get to $100, which will be a year from now equivalent to that free cash flow that we project a year from now. Remember what Warren Buffett said, future cash flow of the business discounted at the proper discount rate. Well, what is the proper discount rate, Mr. Buffett? And if you asked Warren Buffett that question, he would tell you that he uses the going 10-year U.S. Treasury interest rate, since that is a risk-free opportunity cost for his capital deployment. Warren Buffett can always go and buy U.S. Treasuries, and assuming that the U.S. government never defaults on those obligations, that is a risk-free rate. Some other people will use a company's weighted average cost of capital, or WACC, as the discount rate for that company's future free cash flow. Some people use a 10% or 15% discount rate. And here's another point where the art of investing emerges. You get to issue your own discount rate when you evaluate a business. And the result of your calculations will be relative to the discount rates you've chosen. In other words, if you use a 5% discount rate, then the intrinsic value you calculate will be the price you would pay for the company to achieve a 5% annual return. That's why I always encourage investors to view the discount rate as the frame, the paradigm through which you see a range of intrinsic values. Different discount rates will generate vastly different intrinsic values. You will see a totally different array of valuations for various companies when you step from one discount rate paradigm to another. And there is no correct answer for which discount rate to use. In fact, if you were all knowing about the future, really the discount rate should be infinite, because you would know every single opportunity and your rate of return would be infinite, because every second you could buy and sell something that you had the perfect knowledge would go up or whatever. But you can always find a balancing discount rate that equates a business's future earnings and fundamentals with the current market price to gather an implied equivalent annual return. So let's assume we are in the business of assessing the vending machine company in order to attain a 15% annual return. In that case, we should discount all the future free cash flow at 15% per year. If we did that, our present value of future free cash flow through year 15 is shown as follows. And you can see the sum of all of that cash flow, which after we've discounted it is about $720,000. Now, for the perpetual growth of the business past that 15-year mark, we can see that the present value of the company's future free cash flow will continue to decrease and approach zero as time goes on. And if you assume that the company never truly dies but runs in perpetuity with our assumptions, you can use the terminal value equation, which is shown here. And that gives us a remaining present value after year 15 in today's dollar equivalent of $196,900, which means the present day value of all the future free cash flow of the vending machine business is about $916,400. Now, if the debt of the company is, as we said earlier, $120,000, and let's say the assets of the company are $148,000, then we have all we need for our intrinsic value calculation. Intrinsic value is the present value of all the future free cash flow plus today's assets minus the liabilities today. At a 15% discount rate, the intrinsic value of the company today is $944,400. And there we have it. We should be willing to pay $944,400 for the vending machine business today because that is the true intrinsic fair value. Or is it? Remember that phrase, if we were all knowing about the future, and we already admitted we aren't all knowing about the future, so we don't actually know if that's the intrinsic fair value of the company. That's our best estimate based on the most accurate assumptions that we made. And this is where the principle of margin of safety arises. As investors, we want to buy shares in companies at prices below their intrinsic fair value to ensure good returns. And the lower the price relative to its intrinsic value, the better we would feel about owning the company. But how much lower should our threshold be for pulling the trigger? And that just depends. If you're more certain about your assumptions and the projection of free cash flows, perhaps you'll be comfortable with the lower margin of safety. If you're less certain, perhaps you'll feel more comfortable with the higher margin of safety. Nevertheless, determining this value is also part of the art of investing. We should come up with a value, I say typically between 15% and 50%, that we discount from our intrinsic value calculation to ascertain the target price at which we will feel comfortable investing in that business. In this case, since the vending machine business is about average in terms of predictability, let's use a 25% margin of safety. Therefore, we reduce the intrinsic value price by 25% or multiply by 0.75 to get the target price of about $708,000. Thus, unless we are offered to buy the company at less than that price, we'll pass just to be safe. But if the market ever offered us that company for $700,000 or $600,000, we will buy it knowing that we should achieve our target return or higher, even if we were 25% wrong, 25% off in our valuation assumptions. When you start looking at the stock market this way and you start valuing companies, you'll realize it's not always easy to find companies that are underpriced. They become underpriced during odd reactions, fearful selling, wacky market conditions or reactions to flashy but not so substantial headlines, or on the heels of slight and short-term misses on earnings expectations. These occasions aren't common, especially in a very pricey market like we have today. However, if you are patient as an investor, constantly scanning, constantly with your targets in mind, with your targets in place, and if you exercise the temperament that this method provides, instead of being scared or fearful like the rest of the market, you will see opportunities every so often. And you will see companies from time to time that are really great companies. And you will be able to buy those fantastic companies at prices below their intrinsic fair value for the target returns that you want. And you'll be able to thank Warren Buffett for giving you a new mindset, a 30-second summary of intrinsic value, the present value of all the future cash generated discounted appropriately. However, this is not just a science, and it's not just an art. It requires common sense and imagination. It requires awareness of cultural trends and knowledge of financial statements. It requires sticking to the numbers and thinking outside the box. Finding the intrinsic value of a company is very simple, yet it's extremely difficult. It's extremely challenging. And not just finding the intrinsic value, but sticking to that conviction when the market is reacting differently, that's tough. But that's what being an investor is. I hope this video has helped you see stocks from a better perspective. On a separate video, I'll go more into the details of market cap versus per share value, specific financial statement values, and how to look at the health of a business overall to determine how predictable its free cash flow can be. And I'll do a real example on a publicly traded company. If this video helped you, please let me know with a like and subscribe so that you don't miss other value investing tips, lessons, and real stock analysis videos I'm working on. Bye for now, and best of luck investing.